Good evening. Thanks for joining this investor call today. I have my team here in the boardroom. I hope everyone has received the press release, investor presentation. So I am ready to take on questions right away. So let's start with the questions.
Sure. Thank you very much. We will now begin with the question and answer session. Participants who wish to ask questions may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have the first question from the line of Anup Gupta from Perfect Research. Please go ahead.
Good afternoon, sir.
Yes.
Sir, the NPAs are consistently inching up every quarter for last 5 quarters.
Yes.
So could you please share your views on it and what action you are taking to resolve the same?
What action we are taking to resolve the NPAs?
Yes, sir.
So the action of resolving NPAs would be recovery efforts. And if you notice that our recoveries for this quarter and upgrade for this quarter has been phenomenal if you compare to the previous quarters. Last year, same quarter, we had a sale to RCL. We don't even have any sale to ARC this quarter. And the total NPAs, while they are going up, we have always maintained that given our business model, we are quite happy as long as the gross NPA is below 2% and net NPA is below 1%. That is our business model since we are dealing with the SME, self-employed segment. The other point is we must remember that since November 2016, there have been quite a lot of changes in the country, and many of the SMEs have to undergo adjustment to the new way of doing things. Right? And that has also put on pressure. You talk about demonetization, GST, RERA, so many things have happened in the country. And you also please notice that we hardly have any restructured book, and that has been the case for the last many years for us now.
Okay. Yes. Thank you.
Thank you. The next question is from the line of Ashish Sharma from Inam Asset Management. Please go ahead.
Yeah. Good evening, sir. Congratulations on a good set of numbers. Just on the growth aspect, we've seen in the previous quarter the growth has sort of resumed. It is subdued in the last quarter from 20% to 28%. Just some color on as to how do you see post all the GST and the demon-led disruption, how do you see the SME sort of evolving, SME market sort of evolving? Just some color on that. And second question would be on this cost-to-income ratio. Given that we have slowed down our incremental branch expansion, I think most of us is already done, but we are still seeing some bit of elevated cost-to-income ratio. When do you see that sort of inching downwards? So just some color on that, sir.
Yeah. So first of all, please remember that we have a one-time cost of 5 crores this quarter on raising of capital.
Okay.
That is for the raising of capital, including rating agency cost, etc. Okay.
Yeah.
So that is unlikely to reoccur. That is number one. Number two, when you add branches, you don't get the entire cost in the quarter the branch is put.
Sure.
Because you are adding people. Some people are joining the same month. Some people are joining 3 months later. So till the branches reach the full bloom capacity, the cost continues to build. Okay. When we look at branch by branch performance, we have very detailed metrics on branch by branch performance, and whether it be an unbanked location or semi-urban location or urban location, whatever, we have a branch by branch monitoring that we do, and we have a chart which says what should be the target that should be achieved in month 1, month 2, month 3, month 4, like that, all the way till 48 months. So when we look at all the new branches that we have put, barring some branches, some of them are way ahead of that curve, some of them are slightly below, and most of them are following the model that we had put together. Our model is all products, all branches, which means whatever products are applicable or possible in a particular catchment area, we put all those products into that branches, like gold loan, CASA, commercial vehicle, mortgages, whatever be the products that are applicable in that particular catchment area, right?
Yeah.
So the cost income ratio that we are seeing is in line with how we have planned it out, and we are unlikely to add more than 10 to 15 branches in the coming 2 years, which is what I have said in my previous call as well. So cost income ratio should start to come off, not because we are reducing the cost, but more because the volume starts to come up in the branches that we have installed.
Sure.
Okay. The other thing we have to notice is we are also dealing with certain issues. For example, security guard costs are determined by what the government determines as the minimum wages to be paid to security guard. Okay. So if you have security guards, then all of a sudden the cost goes up. So these are all surprises. Similarly, GST is 18%, whereas we are paying a lower this thing on service tax. So that has started hitting us from July. So many of these surprises keep coming, so we have to factor in all that. So as far as we are concerned, we don't see any we don't see any issue with the cost that is building up. We are focusing on getting the volumes up on the branches that we have put. Now you asked a question about our assets growth. Now let me put it this way. I can't give you any guidance on what would be the asset growth this quarter, next year and all. All you have to do is please see our balance sheet in 2014 December, compare it with the 2017 December. You will see we have more or less doubled.
Yes, sir.
That is exactly our intention going forward also. We are trying to double the balance sheet in 3 to 3.5 years. Give or take some 3 months. Don't hold me to the exact number. And the thing is that we have a plan. All of a sudden 3 months we lost during demonetization. Then during GST there's a lot of adjustment that the whole country was going through. So you lose time. So those are interruptions that keep coming. Okay. So all in all, we are looking for 3 to 3.5 years to double our loan book, and that is where we are working towards.
Okay. Okay. No, my question was more on how good is the environment from a growth perspective, because we have seen you go down to 20% and now rebounding to close to 28%. So have you seen, given the disruption in the economy and in the SME sector, is the market now conducive enough for you to grow at the pace?
We had to make a lot of adjustments. We had to change our credit policies to exclude certain types of customers which we may have been doing say prior to December 2016 or even before 2017 July. So we have had to do a lot of changes to our credit policies to make sure that whatever is the environment developing, we are in line with that opportunities that are coming up. So I would say that there seems to be some improvement, but don't forget that there is a lot of capacity also we have added. So some of the growth also is because of the capacity that is building up.
Sure.
If you put a relationship manager this month, he takes about 3-6 months to perform. So the relationship managers and sales people that you would have put 6-8 months ago would all be becoming productive as we move along. So that also is reflected in the volume.
Perfect, sir. Perfect. Thank you, sir. That will be all. And all the best for the next quarter, sir.
Thank you very much.
Thank you. The next question is from the line of Kunal Shah from Edelweiss Securities.
Yeah, hi sir, this is Prakhar from Edelweiss.
Yeah,
a couple of questions from my side. First, so there have been reports regarding some asset quality pressures on LAP segment especially. Your thoughts on the same?
So, since November 2016, okay, self-employed segment has been under some pressure. And please remember that we are dealing with self-employed of small ticket size. we have an approach where we say that not too many loans should be done greater than 3 crores. So our average ticket size ranges somewhere around 40 to 50 lakhs. Many of these customers had to adjust for these demonetization, GST, etc. That is one issue. Second issue is that there is huge amount of competition. So they tend to overextend themselves because there is finance available. Somebody is happy to give a top up, somebody is happy to give a unsecured lending and so on. So I would say that to certain segments of LAP there is definitely delinquency pressure. Wherever we have faced problem, our NPAs had gone up and we seem to be on top of it. Our recoveries are looking okay. I hope we can continue that trend in fourth quarter as well.
So just a continuation to that, which particular segment of LAP wherein you are seeing some pressure?
No, like which particular segment means what? Like there are many segments of LAP. There are small ticket LAP, there are big ticket LAP. Big ticket LAP seems to be under a lot more pressure. Customers who have more than say 3 or 4 crores outstanding and have extended, they have overborrowed or taken more, unsecured loans and all seem to be under some stress. When I look at our LAP portfolio, wherever we have any loan which is greater than 2 or 3 crores and it comes under stress, it becomes a lot more difficult to recover those loans.
Thank you. And so second on margins, so we have been seeing some pressure on yields as such. So any ballpark number as to what is our target margin range that will probably anticipate?
We will keep working on how to build a business model on 375 basis points. Currently it's about 400 odd basis points. We had some benefit of some of the refinances coming at a slightly lower rate. Going forward, I don't see too much improvement in cost of funds, but there has been no reduction in pressure in terms of competition trying to drive down the yield. So I do think that next 2-3 quarters we have to see how the NIMs are, but my expectation is that the NIM could be slightly lower.
What proportion of your book is linked to MCLR, sir, as of
now? We don't have that kind of data shared in these calls. So we do all kinds of loans. Suppose we talk about commercial vehicle, it is a fixed rate loan, right? If you do tractor, it is fixed rate loan. So there are so many buckets that I don't think I can give you that information on this call.
And sir, last thing from my side, in terms of liability, when we look at some of the peer banks, the traction over there has been relatively higher than what we have seen. So
give me what exactly are you talking about? Tell me.
SA growth.
SA growth. Please check guys who are paying more than 4% for all buckets. See their traction versus what we do. We pay above 6% only for 1 crore and above SA. And which are usually institutional deposits, very few HNIs come in that. Below 1 crore we pay only 4%. Compare our SA growth post demonetization, how it has performed. I think we have grown SA by at least about 12 or 15%, which despite the fact a lot of money which came in demonetization actually have exited. We are pretty happy with our CASA performance.
Okay, thank you so much.
And we believe that the base effect of the demonetization would wear off this year and hopefully next year it will be back to normal growth.
Okay, thank you so much, sir.
Thank you. We have the next question from the line of Alok Shah from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. And sir, congratulations on great set of numbers.
Thanks.
I had a couple of questions and maybe starting with the last thing first. On CASA, you talked about base effect kind of wearing off in this year. But as we look into 2019 and 20, would we kind of run with some CASA targets?
Sorry, we what have?
The CASA targets that we would have in our mind.
Ideally, we would like to maintain 25% as the CASA ratio. Okay. So let me explain how we do CASA. We have a target given to every branch, depending upon the category of the branch. We have a target given to every branch on what is the CASA, retail CASA that they have to grow every year. What are the new customers they have to get, what products they have to sell. Usually the sales managers and frontline will not be able to make their incentive if they don't achieve their CASA target.
Okay.
Okay. So from wherever we can see now, the branches which are large, which are like in semi-urban, urban areas, tend to do a much better job on CASA than smaller branches because the population itself is pretty less. Right? In those areas, CASA growth depends on some of the smaller government agencies, panchayat and all, giving us some support in terms of keeping their CASA afloat with us. Okay, and that's a lot of hard work. I mean, you start working on it today, you might land up with a success in about 6 months' time and all, because it takes time to break through those relationships. So we have a strategy for institutional deposit, we have a strategy for individual deposits, we have a strategy for current deposit, current account. All that is all translated into goals to the various branches, and it is monitored on a daily basis on how they are performing. So all that put together, we believe that we should be able to keep CASA at 25%. The first year after that disruption that we will be facing with in 2018-19. So we will see how the momentum goes. But at the moment, we have confidence.
Sure. I know you don't disclose this number, but would it be safe to say that our average CASA balance would be somewhere closer to this, or maybe 200 basis points below this number?
What is 100, 200 basis points?
The average daily CASA ratio.
Average daily CASA ratio. Let me put it this way. Our relationship managers are measured on averages, not on EOP.
Right.
That's all.
Yeah, because that's where
if they do some gaming of the system by bringing CASA end of the month and all, they only will suffer. There will be no incentive given to them on that.
Sure. Okay. The second question was on growth. I mean, you talked about SME growth, where if I look at an YOY basis, that's a strong growth, and even on a QOQ basis, that's like 7% pickup.
Yes.
And then when I also kind of look at my retail and within retail mortgage portfolio, that's kind of seen some kind of pickup. Would it be safe to say that incrementally these two pockets and this being our niche areas would kind of outpace overall growth for our overall portfolio?
I am not able to tell you that. All I can say is that we are focused on self-employed as a segment. Okay. So the pie chart that you see on page number 10 in our investor book, more or less that is how the pie should look, even if you double the portfolio.
Okay. So trying to put it differently, when I look at SME plus retail, today is close to 66% of my overall portfolio. And we have done this number even closer to 68-69% in the past.
It will be in that range.
Okay, sure.
And surprisingly, what we are finding, even though we have not expanded our corporate team at all, I mean, it is the same team that existed, give or take 1 or 2 people in the last whatever number of years. Because so many banks are in a challenging situation because of PCA and so on, we are getting some really high quality corporates, in our portfolio. So we are quite pleasantly surprised as well as happy about it, I would say.
Okay. Now that you've talked about corporate portfolio, what would be the nature of, I mean, the ticket size and the nature of this exposure? I mean,
I have and please don't take it any wrong way. I just believe that no corporate should be given more than 100 crores ever. So therefore, our ticket sizes usually range between 20 to 50 crore. Most of them would be in either consortium or multi-banking. Some would be like a LRD proposal kind of thing. So it depends on what kind of opportunities come. So, and we don't give it to any infrastructure and all. Very few, whatever infrastructure loans and all we've had in the past, that is what continues. We haven't made any major new sourcing of those kind of loans.
Sure. So more of a working capital kind of loan.
More of working capital or term loans, which are short tenor term loans, plus some working capital, that kind of arrangements would be there. And slowly, steadily, we are finding that we are getting very good quality corporates.
Yeah, because if I look at the movement in large corporate, it's kind of been on upward trajectory. And as you rightly mentioned, the space which is kind of got vacant because of some PSUs.
Yes.
Sure. Maybe one more question that I had was on branch or overall cost side. Would it be possible to kind of tell me the employee count? Where I'm coming from is...
It's about 5,600 employees we have at the moment. Okay. So we have added approximately in 1 year we have added about 800 employees we have added.
Sure. So now when I look at my employee per branch count,
so we don't work on that basis. Our employee per bank would be very high if you compare with the Federal Bank or City Union Bank. Our model is very different. We have I don't know what are all the products they do. We do many products. We do commercial vehicles, we do tractors, we do gold loan, we do construction finance, SME, MSME mortgage. So what happens is that when we choose a particular branch, we look at what all the relationship manager or sales people that we have to put in the branch, and we put all of them and we have a tracking for all of them to see whether they are able to perform or not. So we would be probably 20 per branch or something, whereas City Union Bank would be 10 or 12.
No, I get that point, sir, but this is interesting. Okay, and maybe the last thing from my side, when you kind of look at recoveries this quarter, I'm sure there will be a lot of granular part of it, but anything specific to look into it in terms of any space where we have seen considerable amount of recoveries?
No. Our loan sizes are average 40-50 lakhs, so recovery is also like that only. It is, a very granular recovery. So we don't have any big ticket recoveries. We don't have any except for one restructured loan, which I've already mentioned in my press release, which went from restructured standard to NPA, and this account has been with us for the last, if I recall, almost like 10 or 11 years. And this also got affected by the various changes that happened in the country, and they were not able to service their interest or installment, so that went into NPA. So other than that, it's all granular items.
So if I could ask the sector there.
No sector or anything like that. It's all over the place.
No, the restructured portfolio sector.
There's no sector. I mean, I think they are doing some job work for commercial vehicles and other companies. So that is what has gone into some trouble for them.
Maybe the last question, if I could squeeze in.
You have to allow time for others also, no?
Just the last question, sir.
Yeah.
The slippage run rate, I mean, barring this quarter, we are at...
Slippage run rate is in the range of 2.1, ignoring the 15 crore or something like that of a corporate loan that has slipped. Otherwise, we are in the same range. Some quarter it can go to 2.1, 2.12. Some quarter it can be at 1.8. It's very difficult to exactly say that what range it would be. All I'm saying is that we are working towards making sure that our gross NPA is below 2 and net NPA is below 1.
Sure. Thank you so much for all of that.
Thank you. We take the next question from the line of Janvi Goradia from Motilal Oswal. Please go ahead.
Yeah, hi sir. Most of my questions have been answered. Just one, this quarter we've seen very good traction on fee income. If you could provide some insight into that.
So don't draw a trend line based on that immediately. But whatever work we are doing on various items like health insurance, like insurance, mutual fund sales, our focus on making our ATMs more profitable, trade, FX, all those items have contributed little by little. There is a slight base effect, I would say, in the core income, because if you look at the third quarter of last year, our ATM fees is very low. That is because we had to shut down the ATMs on the whole demonetization. So there is, if you see, ATM fees will look much higher this quarter than. Other than that, we have seen pretty decent work on fees, and we hope that we will continue that trend.
Okay, so there is no one-off there.
No. On the other hand, in total fee, not just core fee, in total fee, I think we got much better income on our money market last year, same quarter, versus this year, because GSEC rates have actually moved up this quarter.
Right. And also earlier in the call you mentioned that cost of funds, you do not expect them to go down further.
No.
But we've also revised our FD rates very recently. So shouldn't that provide some sort of a cushion?
No, I think we have kind of tweaked some buckets in FDU. Some have gone up, if I'm not mistaken.
Okay.
Yeah. So cost of fund, to the best of my, I mean, I'm not an expert on interest rate, but cost of fund, according to me, would either stay where here or it is likely to go up as I see it.
Okay, okay. That's it from my side, sir. Thank you
Okay.
so much.
Thank you. The next question is from the line of Rohan Mandora from Equirus Securities. Please go ahead.
Good afternoon, sir. Thanks for the opportunity.
Hi.
Mr. Mandora, if you could speak a little louder, we can barely hear you.
Is this better?
Yes, please.
Yeah.
Go ahead.
So, sir, if you could give some, just to take it forward from the previous question, if you could give some broad quantification on the fee income in terms of how it is spread between, say, loan processing, third party, transaction fee, liability fees.
We have disclosed certain details in our
Right, but sir, within the commission brokerage, if you can give some granularity in that.
So that is all the details we are able to provide to you, and it is, I think, pretty, let me just see, what page is it, Bharat? Yeah, it is there in page 8, right? So we have given you commission, exchange, brokerage, which includes everything from ATM fee to processing fee to bank assurance and all that comes into that case. So we don't have that kind of details given. So this is the detail we are providing to all the investors.
Right. So, I was just wondering if I could get some share like loan processing mode, how that would have moved year on year, quarter on quarter.
We are not giving those details. All I'm saying is that there is no one-off in this, and there is a granular increase in all the lines.
Okay. And so on the non-employee expense side, like 5 crores was the one of expense that we incurred.
Yes.
Anything else which was one of in this?
No, we've disclosed that. I mean, we won't go into the real granular into everything, but the broad number, if there is anything that affects our results, we have always disclosed it. Whether it's one of interest income that we have received because of income tax, we disclose those numbers.
Right. Okay. And so, like, what will be the incremental yields, say, the mortgage, EIB, corporate and SME segments?
Incremental yield?
Yes.
No, the average, we have given the yield number in page number 11, no? 11.25 is our yield on all advances put together, right?
Yeah, so that would be on the outstanding portfolio, but like currently, whatever incremental lending that we are doing.
It depends. I mean, some segments will have higher yield, some segments will have lower yield. There is a risk-based pricing model that we have. So customers who we see from our model as slightly risky will get charged 25 basis point higher. Customers who are really good, who have very good track record and cash flows and so on might have low. So very difficult for me to say exactly. So that's a composite number that we have presented here.
Okay, sir. Thanks a lot.
Yeah.
Thank you. The next question is from the line of Darpin Shah from HDFC. Please go ahead. Mr.
Hello?
Darpin Shah, you may go ahead with the question.
Hello.
Darpin.
Yeah. So thanks for the opportunity.
No problem.
So in October 15, we had guided on certain parameters. How will our ROAs, ROEs, and cost income look by FY19?
Yes.
Now that we have completed a branch network,
Yeah.
and in the interim there are a couple of major events which have happened in the country.
Yeah.
Would you like to revise our guidance for FY19?
It is too early to revise it. I feel that yes, we have got disruption of at least 3 to 6 months because of the major events that happened in our country. So I would say that at the moment the team feels confident of moving towards that goal. So if there is any blip, we will definitely tell you. But the fact is, I look at it two different ways. One is as to what is the things that we said in October 2015. The other thing is, what are we looking at from a 3 to 3.5 year perspective, how this whole loan book will grow, how the deposits will grow, how the business will pan out. So I would say that looking at how we have progressed from December 14 to December 17, despite whatever happened in between, we feel confident that in 3 to 3.5 years we should be double or close to double of the loan book without changing the mix of this portfolio.
Good. So anything more on cost to income? See, you said you had mentioned about 55% by end of FY19.
Yeah.
So anything more there if you can add?
So our first target is to reach that particular goal in the fourth quarter of 2018-19, and then if the board permits, we will be able to give further guidance on that.
Okay, sir. Okay. Thank you very much, sir.
Thank you. The next question is from the line of Rahul Maheshwari from IDBI Mutual Funds. Please go ahead.
Yeah, good evening. Can you give a bit of color? No doubt the CV and the construction finance, the growth rate was good enough, though it contributes less as compared to the other segments. But can we expect the same run rate if at all the macros and all the stays of these two segments?
So commercial vehicle is a amortizing loan. So it's almost like a treadmill sometimes because it's a 3-4 year kind of loans, right? So what happens is that if you originate 100 units, 30 to 40 units run off in that particular month. So we have to keep on adding more capacity and get more volume for us to have similar kind of growth. Having said that, commercial vehicles, given all the robustness that we are seeing recently, we are confident of maintaining it at about 4 to 5% of our total portfolio, and we are doing it in a very steady manner, focusing on good segments which gives us the priority sector lending advantage and all. Construction finance, what is happening is all the good our ticket size are very small here, 10 crore, 15 crore, 5 crore, 3 crore, like that. We are very careful about not extending ourselves beyond that kind of loan size. What is happening is those who are quickly converting themselves into the discipline of RERA, we are finding that the loan repayments of those customers are faster. So the book, even though we will originate a lot of loans, a lot of them are actually prepaying because they are constructing faster, they are able to sell faster, especially in the segment where it is like 40 to 50 lakh rupees kind of, flat cost.
So they are lending to the reputed builders in construction, or can you give a credit rating of?
Construction finance we do to builders who have a track record, there is a parameter that we have. We use that parameter to check their track record. We do certain external agency verification of the builder. We do site visits. We do a lot of due diligence before we actually extend the loan. Okay. What I'm trying to say is that some of these builders who are very good, what happens is they have converted themselves to the RERA discipline quite well, and they're also seeing good sales. Then what happens, whatever money that we have said that they will draw down, first of all they don't draw down the full amount, and then they repay also the loan faster. So I don't see this book growing too fast, given that we will be very careful in terms of who we give this lending to. Having said that, it will still be about 3 to 4% of our book.
Okay. The second thing can you give what kind of credit rating or profile of corporate segment is there in terms of AA or BBB, any breakdown of corporate?
We don't provide that data. We are very careful in corporate banking, and we have been maintaining this at about 15-17% of our total book. Even if we double our book, I still think it will be less than 20% of our total book. The top 20 advances in our bank is less than 7%.
Okay. Yeah. And on the mortgage side, as you earlier also did a commentary, you are going cautiously right now, and going forward also you are finding pain, so this run rate of 20-22% would be maintained, kind of thing?
20-22% run rate should be possible. After demonetization and after GST, credit policies have been tweaked, and our monthly origination has been readjusted. A lot of segments which was quite okay before this, at least to us, doesn't seem to be okay. But there may be other financiers who may find it acceptable, I don't know. So 20-22% growth should be possible in mortgage.
And within 2 years, excellent in terms of the branch expansion you have done. So can you give a breakup in terms of the new branches whichever have been added in this 1 and 2 years? What kind of break even or productivity or ROA or ROE has been achieved at least for a 1 year back branches, so that we can get...
At a branch level, we don't calculate ROE, ROA. At a branch level, we only monitor break-even, year-to-date profit, and cost-income ratio.
So for new branches, what kind of branch profitability has come to take in?
So like I mentioned early in my call, that what we do is we say that every branch will do what volume on a month-on-month basis all the way to 48 odd months. Because sometimes after about 24 months, if the branch is on track, then you don't have to really track it as closely as, although we do that, but you don't need to really worry about the profitability of the branch because it has crossed all the hurdles. So barring a few branches, all the branches that we have put in, whether it be in unbanked area, rural area, it has followed the model. So other than that, we don't disclose any data on a branch-wise basis.
So,
and if it had not happened, our cost-income ratio would have gone for a 70% or something like that. You can see how much cost we have incurred on these branches. It costs at least 60-65 lakhs on an average per branch. And you look at the volume also. We have been growing our volume. If you look at our branches in December 2014, if you see our page number 1,
yep.
It is 130 branches we had in say March 2014.
Yep.
And it is now 311 branches. Look at the balance sheet. It is from 12,000, it has gone to 27,000.
So the intention was that going forward, as you said, that there would per annum the branch expansion would be taking place in 10 to 15 kind of thing, and the cost income ratio won't be declining. So what kind of additional expenses would be incurred in terms of the efficiency kind of thing? If at all, if the branches are not expanding, so what kind of other expenses are there which you might be incurring?
Like employee annual salary increase would be there, inflation related cost would be there. Some of the branches which would have completed 3 years, the rental cost would go up by 5, 7, 10% depending upon what we have agreed with those. So all those costs would naturally come in for all banks. And on the other hand, maybe there is branches which are completing 3 years and all, some depreciation also will follow. So those will be the moving parts for the cost.
But this is the peak cost income ratio, 62.3.
We hope so, and we believe that we are either at peak or near peak on the cost income ratio.
Any target for FY 19-20 for cost income?
We have already published. If you see our October 15 guidelines, fourth quarter of 2019, we want to exit at 55% or below.
Okay. And only one, what is the non-fund based exposure in your book, and what kind of nature of that exposure is there?
Bank guarantees, LCs, little bit of FX derivatives, mostly related with SME segment and little bit to the corporate segment.
Okay. Any stressed account of non-funded which has been into your asset quality?
At any point in time, in the last 9 years that I'm going to complete in the bank, we had some 2-3 corporate accounts in some stress. Okay. So, and we have been managing that. Some we have exited, some have repaid. Things gone, and once in a while we have this mishap like what has gone into NPA, which we are also confident of recovering. I have a lot more confidence of recovering an NPA in SME than I have in corporate, because in corporate mostly other banks also will be part of the lending, and to get to some consensus on how to proceed forward takes a lot of time. That's why the recoveries are somewhat slow in corporate.
So you mean to say that that's appreciated, that the recovery you can do for SME. So going forward, can we expect the recovery rate would be higher than the slippage rate for you?
At some point it will be. I don't know at what point it will come like that. If you see our SME slippages, it has been very minimal. The slippages have come mostly in mortgages in the last year and a half. That too, a lot of the portfolio got affected in the smaller segment because of demonetization and GST.
But your slippages increase in agriculture and inclusive banking. Any
that is because you have to lend for microfinance institutions. About 5% of our lending is to microfinance institutions to complete our weaker section priority sector, which got into a lot of challenge because of the loan waiver, demonetization and all. So I think
now it has been stabilized, according to you.
It should stabilize. I think things are improving. So, but recovery will be slow. Whenever it is unsecured, recoveries will be somewhat slow.
Okay. Thank you so much, sir.
Yeah, thanks.
Thank you. The next question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Good evening, sir. Just two questions. One, when you're going in for recovery today in your LAP portfolio, could you just give some color as to what kind of recovery rates that you're seeing out there? Or is it mostly through a settlement that you are engaging with the borrower? Second is on the SME side.
Go ahead.
Sorry?
Yeah, go ahead.
Yeah, on the SME side, there has been some pickup in credit.
Yeah.
Have you seen most of this coming on the back of GST-related shortfalls which the customers are seeing, or is there some pickup in economic activity in the companies that you are working with?
So I'll answer the last question first. Part of our SME growth is because of the capacities that have come in branches and all, and then since we are doing a lot of neighborhood banking, there's a lot of SME business that we are able to attract. 20% to 25% of our SME business is all either wholesale trade or retail trade. Okay, the rest would be on manufacturing, some services, and so on, so forth. Okay. And what's happening is, in the past we used to ask for VAT receipts for determining the customer's sales performance, his needs, etc. Now we are trying to get the GST details for establishing the same thing. Okay. Whether there has been any economic pickup and all, very too soon to say according to me. We'll see 1 or 2 more quarters. But I would say that in SME working capital lending that has shown, it's gone more than 2,000 crores or something now. We have seen we feel more positive about it.
Now, in the sense is there more credit utilization levels, or is it more newer penetration that you're seeing of customers?
I'm seeing both. In existing portfolio, we are seeing more credit utilization as more business is being throughput in a banking account rather than which they may have been doing in cash. I mean, at least the 15,000 odd customers that we met in the last 6 months, many of them seem to believe that it is better to actually do a throughput through the bank rather than do it in cash. Okay, so whether all that would translate into this thing, because they're all anecdotal, whether it's all actually translating into a full-fledged change, I'm not sure yet.
Sure.
Yeah. So SME, I feel positive. I think there will be, and especially those who are making the change to comply with GST and do all the necessary things. I think there's some improvement. We can definitely say it's happening. Okay.
Now, sorry, just one clarification. When you're speaking to your borrowers, you're saying that this year revenues that they are likely to report is going to be meaningfully better than last year.
Sales definitely. I don't know about revenues, right?
Yeah.
Sales definitely they will report. I'm sure they will find ways of managing their profitability. But sales definitely we find, and again we decided that even before demonetization and GST, I can tell you that it is very difficult to assess the needs of a customer who has too much of cash. It's very difficult, and it can't be trusted. So it's very difficult for me to lend to those customers. So even before, we used to lend to customers only with VAT receipts and proper records and things like that. Okay. Sure. He may not have proper income tax record, but definitely on sales side, he has to have very good records.
Fair, sir.
Right. So coming to LAP, first of all, let me put it this way. We as a team and management believe that unless the customer is a fraud, or he is absconding, or he has completely collapsed in terms of his business, the only best way to do your recoveries is to cooperate with the customer, work with the customer, and realize your asset value rather than try and do some long drawn legal process. Okay. Of course, we will file SARFAESI. Of course, we will send him legal notice. That is more to keep that option open and keep the pressure on the customer. Now, when I say this, I even mean bigger customers, which are corporate customers. I would like to believe that seeking the cooperation of the customer gets better asset value than trying to fight with him on the assets. That's our go-to approach. Okay. So if you look at our lab recoveries and all, we would actually work with the customer. We would have sent him the notice and all. We will tell him, why don't you settle it, because if we sell the property, we will realize less value, and then you won't even get the surplus that might be there, or find him some buyers who are good and tell him that why don't you use this buyer to take it. So there's multiple ways in which we deal with the thing. Very rarely we actually auction the property. Very rarely.
Sure, sir. Just the reason why we are asking is that if assets are now being kind of put into the market, we're just trying to see if you're able to kind of recover the value which was initially estimated on that property.
If the value is 100, the moment the bank is involved in trying to sell it and all, automatically it will become some 70, because they know that the bank is trying to sell. So it is better to cooperate with the borrower and find the buyer. He will also get some surplus balance of what he has repaid us. He will also get some surplus. Otherwise, it's a lose-lose for both borrower and bank.
Fair enough. Thanks a lot, sir.
Yeah.
Thank you.
We have time for a couple of more questions.
Sure. We'll take the next question from the line of Dhaval Gada from Sundaram Asset Management. Please go ahead.
Hi sir, just a couple of questions. Firstly, just wanted to understand the experience on the personal loan segment, and in the pie chart we do not see it's mentioned, so I believe it would be less than 1%. Any thoughts of how it is scaling up and the portfolio quality?
So, we have less than 100 crores, if I'm not mistaken, on personal loans. Probably 50 crores, I don't know, something like that. It's a very small team. We are mostly trying to do cross-sell to our own existing customers who may otherwise be taking personal loan from other banks. The ticket size are very small. It is not business installment loan of 35 lakhs and that type of thing. It's only personal loan of 3 to 5 lakh rupees on an average. And the experience so far has been very good, but it is too early to say. We are very cautious about how we are going to scale up this business. And in any case, even 3-5 years from now, it is unlikely to be more than 3 to 5% of our total portfolio.
Sure. Okay. And the second question, sir, just a little broad base. So currently, after the branch expansion, in your assessment, what would be the capacity utilization in the sense that this capacity adjusted for inflation, cost inflation and basic additions, what kind of loan book we can achieve in your assessment?
It's a very fairly complicated and intelligent question, but I'll try to give you the way I see this issue. You look at what is the average business of City Union Bank per employee. I think it is about 13 crores. If I look at ours, it's probably less than 8 crores. Okay. So right. The way I see it is, that is the utilization we want to hit in the next 2 to 3 years. And remember, we are trying to build this on small ticket business. When I say small ticket, not like microfinance. I'm talking about like average ticket size of 30, 40 lakhs, that type of ticket size we are trying to build. City Union Bank is an example I've taken because we believe that it's a good model that we can, although they don't do all the products that we do, but we are quite impressed with their productivity, cost income ratio and so on. So I would say the capacity, there's a lot of capacity that we need to kind of utilize. Having said that, there are branches that are doing astonishingly well even though they are new. So we will end up giving more headcount to them in the coming months, years. That is number one. Number two, some of the portfolios that we do are amortizing portfolio. For example, commercial vehicles, for example, tractors, for example, mortgages. Now, if we have to maintain the growth rate in that, we have to keep adding some capacity to those so that our new sales is good enough to grow the balance sheet at that level. So there are multiple things happening, but our go-to is at least try and reach the City Union current productivity level in 2 to 3 years.
Perfect, sir. Thank you.
Yeah. Let's take the last question because I have another conference call coming up.
Sure. Due to time constraints, we'll be able to take one last question. The last question is from the line of Ramesh Rachuri from Cyient Capital. Please go ahead.
Good afternoon, sir. First of all, congratulations in terms of how you have lowered the duration on your AFS and that portfolio well in time before the yields could rise. Now, related to that, most of the questions have been answered, but one thought that I had was, if we see an interest rate regime which will starting to go up. I mean, today morning, Axis Bank increased its MCLR rate by 5 basis points. Maybe that is a start. So do we, the basic point is the strategy on which you have run by maintaining a CASA of around 25% plus, except in March 2015 when it dipped below that. So is that a feasible strategy going forward, particularly if interest rates rise? And concomitantly in that regime, how do you see credit costs panning out? Thank you, sir.
So credit costs we'll approach separately. Credit costs, barring any major surprises that may happen once in a while in our anyway smaller corporate book, we see that we will be pretty much in control of the rest of the retail and SME portfolios. Okay, because the way we manage the portfolio is, as we see any issue in any pocket coming up, we take actions, both corrective actions and recovery actions on those portfolios. So therefore, we see that pretty much as predictable in terms of how it will come. Okay, so credit cost, we believe, including, the credit cost has been maintained at about 50-60 basis points, and that is where we are aiming to keep that credit cost. Okay, when interest rates go up, there is always a pressure on credit cost, but such a cycle we have already gone through once about 3-4 years ago, and we didn't see any major issues on it. When we are dealing with, say, mortgages where the customer has got self-occupied property, I don't believe that they default because of their interest rate going. Some might, but not in any meaningful manner. Now, with respect to CASA ratio, our intention is to keep the CASA ratio at about 25%. There is a lot of work going on product distribution, sales monitoring, sales tools, training, and so on across the footprint. Some of them are yielding good results, some of them are still work in progress. So, like I said right in the beginning of my call, if RMs don't achieve their CASA, they will struggle to get their incentives. So we believe that would help us to keep our cost of funds in check. But the cost of funds are going up, and if it will go up in a while, shortly, and then we will have some challenges coming up in fixed rate portfolio. So we have to manage all that as we move forward. Hello?
Yes, sir. Thank you.
Okay, thanks a lot, everyone. And if there are any questions that I have not been able to answer, sorry, because I have a staff call, conference call starting in about 5 minutes for which we have to prepare, so we are not able to take any further questions. But please feel free to write to Gaurav or Bharat, and we'll be happy to address it on a one-on-one basis. Thanks very much for attending this call.
Thank you very much. On behalf of DCB Bank Ltd, that concludes this conference. Thank you for joining us, ladies and gentlemen. You may now disconnect your lines.